Panic of 1837. Western expansion led to a surge of land speculation, with investors taking out large loans to buy land in the West. This created a real estate bubble. At the same time, an oversupply of cotton on the global market caused prices to crash. Since cotton was a key U.S. export, this hurt American trade and weakened financial stability. Meanwhile, President Andrew Jackson issued the Specie Circular, requiring land purchases to be made in gold or silver instead of paper money. Around the same time, British banks raised interest rates and demanded that U.S. debts be repaid in gold and silver as well. This drained precious metals from American banks. The resulting cash shortage triggered widespread bank failures and a collapse of credit. Though Jackson had already dismantled the Second Bank of the United States in 1836, its absence made the crisis worse by removing a central financial backstop. The Panic of 1837 sparked a deep economic crisis that spread globally, shattered trust in the banking system, and led to a depression that lasted into the mid-1840s. The Panic of 1873, also known as the Long Depression, was caused by the overexpansion of railroads, which were built too quickly using credit. The collapse of J. Cook and Company, a major investor in railroads, triggered panic. Investors rushed to pull their money out of banks. As banks stopped lending, businesses failed, and unemployment surged. Over 18,000 businesses collapsed. Unemployment hit 14% and labor strikes erupted across the country. This became the first major global economic depression in the industrialized world. It marked the end of America's post-Civil War economic boom and shifted power away from the railroad industry, exposing the dangers of rapid, unregulated growth. The Panic of 1893 was caused by overbuilding and speculation in railroad development, much of it fueled by borrowed money. Many railroad companies were unprofitable and overextended. When several major railroads collapsed, it triggered panic in the financial sector. As banks failed, credit dried up, and confidence in the economy collapsed. At the time, the U.S. was on the gold standard, but the government also allowed the use of silver. The Sherman Silver Purchase Act required the government to buy large amounts of silver, raising fears that the U.S. would abandon gold, weakening trust in the dollar. As a result, hundreds of banks and over 15,000 businesses failed. Unemployment rose to 25% in some areas. The crisis sparked widespread labor unrest and protests, including the famous Pullman Strike of 1894. By 1895, the U.S. Treasury's gold reserves had fallen dangerously low, below $100 million. The government was at risk of defaulting on its gold obligations, which would have destroyed confidence in the dollar. J.P. Morgan, a powerful private banker, stepped in with a $65 million gold loan to the U.S. government in partnership with Rothschild and Company in Europe. This move helped stabilize the Treasury, restored investor confidence, and stopped the run on gold. The Great Depression began after the Roaring '20s, a time of booming economic growth and widespread optimism. Stock prices hit record highs, encouraging everyday people to invest, often using borrowed money or buying on margin. When the stock market crashed in 1929, investors rushed to withdraw their savings. But many banks had also invested depositor money in the market, and they collapsed too, triggering a massive banking crisis. Thousands of banks failed in the early 1930s, while unemployment soared to a record 25% in the U.S. Massive poverty and homelessness lead to breadlines and soup kitchens being very common. The economy didn't really recover until President Franklin D. Roosevelt introduced the New Deal, which created Social Security, unemployment benefits, job programs, and regulations for banks like the FDIC and SEC. The economy fully recovered during World War II because of wartime production and employment, starting in 1941. The 1973 to 1975 recession was fueled by the oil crisis, when OPEC imposed an embargo on the U.S. and other nations that supported Israel during the Yom Kippur War. Oil prices quadrupled overnight, leading to gas shortages, long lines at stations, and soaring transportation costs. At the same time, the economy faced stagnant growth, high inflation, and rising unemployment, a rare combination known as stagflation. Traditional economic tools couldn't fix both inflation and stagnation at once, making the crisis harder to solve. By mid-1975, unemployment hit 9%. Inflation reached 12% and the stock market lost nearly 50% of its value in just 1 year. The recession ended after the Federal Reserve gradually raised interest rates to combat inflation. Recovery began in late 1975, but slow growth in inflation lingered into the late 1970s. The early 1980s recession was actually two back-to-back recessions, the first from January to July 1980, and the second from July 1981 to November 1982. Building off the inflation crisis of the 1970s, prices were still rising rapidly by the early 80s. To combat this, Federal Reserve Chair Paul Volcker raised interest rates as high as 20%, intentionally triggering a recession to break inflation by shrinking the money supply and curbing spending. At the same time, the 1979 Iranian Revolution caused another spike in oil prices, which led to higher energy, food, and transportation costs. Unemployment soared to 10.8%, the highest since the Great Depression. Interest rates were so high that home buying and business borrowing became nearly impossible. Despite the pain, the recession succeeded in crushing inflation, which fell from 13% in 1980 to about 3% by 1983. The recovery was also fueled by Reagan's tax cuts, increased defense spending, and deregulation. The late 1990s saw explosive growth in internet access, leading to a surge in tech stocks. Companies with .com in their names often doubled or tripled in value overnight. Investors poured money into internet startups, most of which had no profits, no products, and no real business plan. Cheap money and easy capital encouraged venture capitalists to fund almost any internet-related idea, resulting in massive overinvestment in unsustainable businesses. By the early 2000s, reality set in. Most of these companies weren't profitable and were burning through cash quickly. A high-profile example was Pets.com, which became a symbol of the crash. The Nasdaq, heavily weighted with tech stocks, crashed and lost over 75% of its value between 2000 and 2002. The collapse wiped out trillions of dollars in market value, caused thousands of tech workers to lose their jobs, and led to the bankruptcy of hundreds of startups. Many long-term investors lost significant savings. The crash triggered a mild recession, worsened by the September 11th attacks in 2001. Still, some companies from that era survived and thrived, including Amazon, eBay, and Google. The Great Recession from 2007 to 2009 was widely considered the worst global economic crisis since the Great Depression. It was caused by a housing bubble, as banks handed out risky mortgage loans, including subprime mortgages to people with poor credit. Many believed housing prices would continue to rise, allowing them to buy homes and sell later for a profit. But when people began defaulting on their loans, the housing market collapsed. Banks and investors were heavily exposed because they had packaged these bad loans into mortgage-backed securities. The risk was spread throughout the financial system, and because institutions were heavily leveraged, borrowing massive sums to bet on these assets, the entire economy was affected. In 2008, major financial firms like Lehman Brothers collapsed, while others like AIG, Bear Stearns, and Merrill Lynch nearly failed. This triggered a global credit freeze, as banks stopped lending to each other and to businesses. As a result, unemployment peaked at 10% in the U.S. Millions lost their homes, and the stock market plunged, wiping out consumer wealth. To stop the collapse, the U.S. government and Federal Reserve stepped in with bank bailouts, near-zero interest rates, quantitative easing, and massive stimulus packages. Eventually, these measures stabilized the economy, though the recovery was slow and left lasting economic and political effects. The 2020 recession was caused by a global pandemic that forced much of the world into lockdown. This led to broken supply chains and a sudden collapse in consumer spending. Within weeks, tens of millions of people lost their jobs in the U.S. alone. The stock market crashed, with the S&P 500 dropping 30% in just a matter of weeks. In response, governments launched massive stimulus programs, including direct payments, expanded unemployment benefits, and business loans to stabilize the economy. By mid-2021, widespread vaccine distribution allowed economies to gradually reopen. Consumer spending rebounded, especially in digital and e-commerce sectors. The result was a sharp but short recession, followed by a rapid V-shaped recovery in financial markets.